Welcome to The Explainer. For as long as we've been around, we've been trying to figure out how to control the future, or at least our financial future. Today, we're going to unpack that story. It's a long one, and it's absolutely fascinating, connecting ancient farmers all the way to today's super-fast algorithms.
So let me start with a question for you. It might sound a little bit like a riddle. What on earth could possibly connect an ancient Greek philosopher, a Japanese rice merchant from centuries ago, and a modern-day Bitcoin trader? I mean, they're worlds and centuries apart, right? Well, the answer is actually pretty simple and kind of brilliant. They all use the exact same basic tools to try and manage the risks of tomorrow.
But before we get into the tools themselves, we gotta go way back. We have to understand the problem they were designed to solve. And it's a big one, maybe the big one: uncertainty. How do you possibly plan for a future that you just can't predict?
Okay, so the two big tools we're talking about are futures and options. And to really get it, you just need to remember one crucial difference. It all comes down to obligation versus choice. A future is an obligation. You have to buy or sell. You're locked in. But an option, well, it's just that. It's the right, the choice to buy or sell, but you're not forced to. Think of it like this. A future is like promising your friend you'll buy their car next month for a set price, no matter what. An option is like paying that friend $20 to hold the car for you, giving you the choice to buy it at that price, but if you change your mind, you just lose the $20. See the difference? It's huge.
And what's really wild is that these ideas aren't new, not even close. We're talking thousands of years ago. In ancient Mesopotamia, farmers were essentially using futures. They'd lock in a price for their crops before they were even harvested so they wouldn't get wiped out if prices crashed. And then you've got this story about the philosopher Thales. He had a hunch there was going to be a massive olive harvest. So what did he do? He used an option. He paid a small fee to reserve all the olive presses. He didn't buy them, just the right to use them. And when the huge harvest came and everyone was desperate for a press, he rented out his rights and made a fortune. They didn't call them futures and options back then, of course, but the basic idea, exactly the same.
So this incredibly powerful idea starts on the farm, but it doesn't stay there. It spreads. As global trade exploded, with ships crossing entire oceans, these simple tools had to level up. They had to get faster, bigger, and a whole lot more sophisticated to keep up.
I mean, you had Italian merchants in the Middle Ages selling cargo that was still bobbing around on a ship somewhere. Then came the infamous Dutch tulip mania in the 1600s. People weren't even trading tulips anymore. They were trading contracts to buy tulips in the future. It got so insane that a single contract for one bulb could be worth more than a fancy house. It was a total bubble. But the real game changer, the place where this all got serious, was in Japan. Around 1730, the Dojima Rice Exchange created the world's first formal, organized futures market. This was the blueprint. This is where it all started to look like what we have today.
And that Japanese blueprint, well, it set the stage for a massive revolution over in 19th century America. And it all started, once again, with a problem on the farm.
Okay, try to picture this. It's the mid-1800s. You're a farmer in the American Midwest. Every fall, you and every other farmer for hundreds of miles harvest your grain all at the same time. You all rush it to the nearest hub, which is Chicago. So what happens? The market gets absolutely flooded with grain and the price just collapses. It was a disaster year after year. The Chicago Board of Trade, the CBOT, was created in 1848 to solve that exact problem. Chicago was the perfect spot. It was where the farms met the brand new railroads.
And what they did was genius. It was a total game changer. Before the CBOT, if you made a deal to sell your grain in the future, it was just a private handshake deal. It was custom, and it was super risky. I mean, what if the other guy just couldn't pay up when the time came? You were out of luck. The CBOT changed all that. They introduced standardized futures contracts. Every contract was for the same amount of the same quality grain. They were traded out in the open on an exchange. And, this is the most important part, they were guaranteed by a clearinghouse. That meant you didn't have to worry about the other person defaulting. The exchange guaranteed the trade. Suddenly, the risk was gone and the market was safe and open for everyone.
So, okay, futures are on this path to becoming respectable, standardized, and, well, kind of boring. But options? Oh, their story was completely different. They had a much shadier journey into the mainstream.
Yeah, for hundreds of years, options were basically seen as pure gambling. They were the kind of sketchy side bets you'd make in the back of a London coffeehouse. In fact, they got such a bad rap after helping cause the huge South Sea bubble to crash in the 1720s that they were actually banned for a while. They were just not seen as a serious financial tool.
And then, a single year came along that changed everything. One pivotal year that took options out of the shadows and put them center stage. That year was 1973.
What happened in 73 was like a 1-2 punch that legitimized options overnight. First, Chicago did it again. They opened the Chicago Board Options Exchange, or CBOE, the first regulated, standardized market just for options. That was punch 1. But punch 2 was the real knockout. Two guys, Black-Scholes, came up with a mathematical formula, a way to actually calculate, with science, what an option should be worth. It turned options from a pure gamble into a calculated risk. That combination of a safe place to trade and a scientific way to price them, it completely transformed them into a core tool of modern finance.
And that brings us to the modern era, where these tools, both futures and options, just exploded. They went way beyond just grain and olives. They're now in every corner of the financial world. And that's where we see that they're really a double-edged sword. They can create incredible value, but they can also create spectacular new kinds of danger.
Let's talk about the good side first. The whole reason these things exist is for hedging, for managing risk. Think about an airline. Jet fuel is one of their biggest costs. If they can use a futures contract to lock in the price of fuel for the next year, they can plan their business without worrying that a sudden price spike will completely wipe out their profits. Or a pension fund, right? They can use options to protect all those retirement savings from a big market downturn. This is the intended use, helping real businesses navigate the very real risks they face every day.
But here's the dark side. The very same power that makes them so good for hedging risk can be flipped around and used for massive, high-stakes speculation. It's like financial dynamite. And when those bets go wrong, they go spectacularly wrong. We saw it in 1995 when a single trader's bad futures bets literally bankrupted Barings Bank, a bank that had been around for over 200 years. And of course, we saw how incredibly complex derivatives, like credit default swaps, basically poured gasoline on the fire of the 2008 global financial crisis.
Which brings us pretty much up to today. You know those old pictures of traders yelling and screaming and waving paper in a crowded pit? That's all gone. It's been replaced by silent server farms and global electronic networks. These ancient ideas, born on farms and in rice markets, are now applied to everything you can imagine: currencies, stock indexes, even crypto, with trades happening in fractions of a second, all driven by algorithms.
And when you step back and look at this whole story, it's pretty profound, isn't it? It really shows that whether you're a farmer in ancient Babylon worried about the price of your harvest, or a high-frequency trader today betting on where Bitcoin's headed next, the fundamental human drive is exactly the same. We're all just looking for a way to tame the unknown, a way to manage the uncertainty of tomorrow,